This is the story of what happened when America's most powerful financial machine hit its peak and then came apart in a matter of days. In October of 1929, investors who thought stocks had reached a permanently high plateau instead watched Black Thursday, Black Monday, and Black Tuesday tear through Wall Street and rewrite financial history. All through the 1920s, the market looked like a perfect engine for getting rich, as the Dow Jones Industrial Average climbed from about 63 in August 1921 to 381 in early September 1929, the highest level it had ever reached. That rise turned the Roaring Twenties into a story of easy gains and rising confidence, and every new high made people even more certain that this was the new normal. The result was a rush into speculation, where the price of stocks mattered less than the belief that someone else would pay more tomorrow. Margin buying turned that belief into something dangerous because investors could put down only 10% of the money and borrow the rest from brokers, which meant a small drop in prices could wipe out their entire stake in a single day. By October 1929, brokers' loans had piled up to more than $8.5 billion, a figure that actually exceeded all the US currency in circulation at the time and showed just how much of Wall Street's boom rested on borrowed money. That level of leverage suited a market where confidence stayed high, yet it created a structure where any serious shock could turn enthusiasm into forced selling very quickly. Warnings did exist, and one of the loudest came on September 5, 1929. When business forecaster Roger Babson told an audience that sooner or later a crash is coming and it may be terrific, adding that wise investors would get out of debt. Just over a month later, on October 15th, economist Irving Fisher stood on the other side of that divide and announced that stock prices have reached what looks like a permanently high plateau, and he said he expected the market to stand higher within a few months. Two clear predictions met the same overheated market, and only one of them would match what actually followed. Behind the soaring averages, the real economy already showed stress, as American farmers struggled through a deep agricultural depression, while sectors like steel, construction, and automobile production cooled off after the early decade surge. Households leaned more and more on installment credit to keep buying goods, which meant much of the consumer strength investors relied on came from borrowed money instead of growing paychecks. The market kept climbing anyway, and that gap between financial optimism and weaker fundamentals grew wider with each new high. That changed when selling pressure started building in October, and it came into sharp focus on Wednesday, October 23, 1929, when stocks dropped sharply in the final hour of trading and erased confidence that prices would simply rebound as they always seemed to do. The late plunge triggered a wave of overnight margin calls, and brokers demanded fresh cash from clients who had used heavy leverage to buy their positions. All of that set the stage for the next morning. And that is when the most famous day in market history began. When the New York Stock Exchange opened on Thursday, October 24th, the decline started immediately, and prices fell around 11% almost at once as sell orders hit the floor faster than buyers could absorb them. Trading volume exploded, eventually reaching nearly 12.9 million shares by the close, which broke every existing record and overwhelmed the exchange's systems. Ticker machines could not keep up. The tape ran as much as hours behind, and investors staring at quotes in brokerage offices across the country no longer knew what their holdings were actually worth. Wall Street itself turned into a pressure cooker as phone lines jammed and messengers ran between offices with incomplete prices and urgent instructions. And the result was a sense that the usual rules had stopped working. Around midday, the response from the financial establishment finally took shape inside JP Morgan and Company's headquarters at 23 Wall Street, where senior figures gathered in a room that symbolized old guard American finance. Thomas W. Lamont represented the Morgan firm, Charles E. Mitchell came from National City Bank, Albert H. Wiggin arrived from Chase National Bank, William C. Potter sat in for Guaranty Trust, and Seward Prosser joined from Bankers Trust, and newspaper reports said this group controlled more than $6 billion of massed banking resources. And that is when they decided to stage a visible show of support for the market, using an old tactic known from earlier panics. Shortly after 1:30 in the afternoon, Acting Exchange President Richard Whitney walked calmly onto the floor and headed straight for the post where U.S. steel traded, carrying orders from the Bankers Group. In a voice everyone could hear, he bid $205 for 10,000 shares of U.S. steel, matching the last sale price instead of offering a discount, and he did the same with large blue-chip names at other trading posts. Only a fraction of those orders actually traded because few sellers wanted to take that price amid the chaos. Yet the impression mattered more than the volume, and traders interpreted the move as proof that the big banks were standing behind the market with real money. The effect spread quickly, and prices across the floor began to lift as panic selling eased, which meant the worst losses of the morning did not fully survive to the closing bell. Headlines the next day praised the bankers as saviors, and many investors convinced themselves that the worst had passed. On Friday, President Herbert Hoover reinforced that idea by telling the country that the fundamental business of the country, that is the production and distribution of commodities, is on a sound and prosperous basis, and his words aimed to steady nerves that still felt raw from the sudden drop. Black Thursday looked like a crisis contained, yet the underlying leverage and fear remained in place, and the real collapse still waited just ahead. Trading on Friday and the close weekend that followed gave the market a brief pause, and many investors clung to the belief that the bankers' show of strength had restored order. That illusion faded as soon as trading resumed on Monday, October 28th, when selling pressure returned with more force and buyers stepped back. By the end of that single session, the Dow had dropped about 12.82%, one of the steepest daily declines in its history at that time, and brokers now faced clients who had already been hit with margin calls after the previous week. The next day, Tuesday, October 29th, turned that crisis into something much larger, and this is the day that entered history as Black Tuesday. More than 16 million shares changed hands, which meant yet another shattering volume record, and prices tumbled as sell orders flooded the floor faster than any coordinated effort could absorb them. Reports from the time described stocks that seemed to have no buyers at any reasonable price, and each new drop in one major issue triggered forced selling in others as brokers liquidated accounts that no longer had enough equity to cover loans. Prominent industrialists and financiers did attempt another rescue effort on Black Tuesday, and one of the most visible figures was General Motors co-founder William C. Durant, who joined with wealthy investors, including members of the Rockefeller family, to buy large blocks of stock in a show of confidence. Those purchases could not overcome the scale of the panic, and by the closing bell on October 29th, the Dow had lost another 11.7% or so, on top of Monday's collapse and the damage from October 24th. The dream of steady, unstoppable growth that had defined the late 1920s bull market did not survive that week, and the belief that blue-chip stocks could only move in one direction vanished with it. When investors finally stepped back and looked at the damage, the numbers told a harsh story, because between September and November 1929, the total market value dropped from roughly $64 billion to about $30 billion, and more than half of the paper wealth built during the boom had evaporated. That loss did not mark the end of the slide, as the Dow continued to drift lower over the next few years until it touched 41 in July 1932, a level almost 89% below the 1929 peak. Not until November 23, 1954, did the index finally climb back to the old high of 381, which meant investors who bought at the top had waited a quarter of a century just to break even. Stories that grew up around the crash gave it an almost mythic quality. And one of the most enduring images described desperate financiers leaping from tall buildings in a wave of suicides on Wall Street. Later work by economists and historians, including John Kenneth Galbraith and researchers at the Hoover Institution, showed that no such spike in suicides occurred in October or November 1929, and that overall rates were higher in other periods, especially as the Great Depression deepened in the early 1930s. Individual tragedies did happen, yet the dramatic vision of sidewalks lined with ruined brokers came more from dark humor, rumor, and later retellings than from actual statistics. The crash did not instantly produce the full Great Depression, but it clearly broke confidence in the idea that prosperity would simply extend itself without risk, and it helped set off years of financial and political change. Lawmakers responded with a new regulatory framework that still shapes markets, starting with the Securities Act of 1933, which required companies to provide detailed information to investors when issuing securities. The Securities Exchange Act of 1934 followed and created the Securities and Exchange Commission, giving the federal government a permanent agency to oversee securities markets and police fraud. The Banking Act of 1933, often called Glass-Steagall, split commercial banking from investment banking and introduced federal deposit insurance. and the result was a system designed to prevent depositors' money from fueling another speculative spiral like the one that ended in 1929. The story of October 1929 shows what happens when a financial machine built on optimism, leverage, and faith in endless gains collides with fear. In the span of a few weeks, a market that had climbed from about 63 to 381 over 8 years saw its most important promises collapse under the weight of debt and forced selling. Roger Babson looked at the same market and warned that a crash was coming and that it might be terrific, urging investors to clear their debts, while Irving Fisher stood just days before the real trouble and described stock prices as having reached a permanently high plateau. History remembered both names, yet only one of those forecasts matched what followed when the final financial hours of the 1920s came to an end.